If I were sitting across from you at a kitchen table today, and you told me you plan to retire in the next 5 years, I would not begin by asking what stock you wanted to buy. I would begin with a different question. What part of your portfolio depends on the world remaining comfortable? That is the question most people avoid because the market still looks respectable from a distance. The headlines still sound manageable. The index still gives people permission to relax, and that is exactly what makes this period dangerous. The worst losses I have seen in markets rarely begin with universal panic. They begin with surface calm. They begin while people are still saying things like the economy seems fine, unemployment is not terrible. The big indexes are holding up, so why should I worry? I have lived long enough to know that a house can look perfectly fine from the front yard, while the beams under the roof are already starting to rot. That is how I think about the financial system right now, not as a machine that has already exploded, as a machine running with hidden strain. The public sees prices. I prefer to look at plumbing. And the plumbing is where the trouble is. Most investors are still looking at the stock market the way tourists look at a river. They admire the surface. They do not study the current underneath. What matters now is not whether a few popular stocks can still drift higher for another month or two. What matters is whether liquidity is being added to the system or drained from it. That sounds technical until it hits your life. Then it becomes painfully personal. A portfolio can survive many things. It can survive a period of underperformance. It can survive a year of boredom. It can survive looking too conservative while speculative neighbors brag at dinner. What it does not easily survive is a major break when you are too close to needing the money. A 30% drawdown at 35 is unpleasant. A 30% drawdown at 63 can rewrite the next decade of your life. That is the part I wish more people understood. The market does not just take money, it takes options, it delays retirement, it changes medical decisions, it changes where you live. It changes whether peace of mind exists inside your own home. I have seen enough of that to take it seriously, and the arithmetic in front of us now deserves seriousness. I have spent much of my life telling people not to overcomplicate investing. That remains true. But simple does not mean passive. Sometimes simple means asking the hardest question with total honesty. If the world is entering a season where debt is too large, refinancing is too expensive, and policymakers are forced to choose between recession and inflation, what actually holds up? That is the whole assignment, not what sounds sophisticated, not what looked brilliant over the last easy stretch. What holds up when the tide stops flattering everybody? The first thing I would tell you is this: the liquidity squeeze has already begun. Most people just do not recognize it because they are looking at headline prices instead of the machinery funding those prices. Here is the simple version for years. The system has relied on more debt, cheaper refinancing, and the belief that if anything truly broke, the central bank would ride to the rescue and smooth everything over. That habit worked long enough that people began treating it as natural law. It is not natural law. It is borrowed time. And borrowed time always sends a bill. The bill is arriving through plain arithmetic. Government debt has grown to a size that would have seemed absurd to the sober men of earlier generations. Interest expense on that debt is no longer a side item. It is becoming one of the main items that matters, because interest is dead weight. It does not build bridges. It does not train workers. It does not create productive capacity. It services yesterday, and when yesterday becomes expensive enough, tomorrow gets squeezed. That is where we are headed. Old debt is rolling into new debt at higher rates. Every refinance raises the carrying cost. Every increase in carrying cost competes with something useful. And at the same time, the government still has to sell enormous amounts of new debt just to keep the machine moving. Now ask the next question: who buys all of it? That is where the story stops being abstract. For a long time, the world was happy to absorb a remarkable amount of American paper. Foreign buyers, reserve managers, institutions, and global capital all help support that structure. But when major outside buyers slow down, diversify, or simply become less enthusiastic, the burden shifts inward. And when it shifts inward, money that might have financed productive businesses, housing, small enterprise, or risk capital gets pulled into government financing instead. That is a liquidity drain. It is a quiet one at first. It does not announce itself with fireworks. It works like this. A dollar that goes to fund deficits is a dollar not doing some other job in the private economy. A dollar parked in short government paper is not bidding up a shaky growth stock. A dollar trapped defending old debt structures is not financing new expansion. That is why a system can look healthy in the broad averages while becoming weaker in the joints. The second part of the squeeze is monetary policy. If central banks are still shrinking their balance sheets, or even simply refusing to flood the market the way they once did, then the cushion investors got used to is thinner than they realize. So you have one force pulling money out through heavy government borrowing, you have another force refusing to pour fresh liquidity back in with the same enthusiasm, and you still have an investment world priced as though easy rescue remains available on demand. That is not a small mismatch. That is the whole danger. I have no interest in dramatic language for its own sake. I dislike theatrical finance, but I respect patterns. And the pattern I see is a market still smiling on the front page while the funding conditions underneath it get tighter by the quarter. That kind of environment does not usually break all at once. It breaks in sequence. The first phase is the illusion. That is the phase where high rates exist. But markets still levitate because some temporary source of liquidity or optimism is masking the real pressure. People point to the index and say, "See, nothing is wrong." What they do not see is that the strength is narrowing. Trading gets thinner. Speculation becomes more crowded, not healthier. The weakest areas of the market stop participating, but the headline averages stay upright because a handful of giants are still holding the roof. That fools people. It always does. The second phase is the squeeze. That is the phase I think we are living through now. The old cushions are mostly gone. The easy injections are not there in the same way. Borrowing needs remain huge. Liquidity starts evaporating beneath the surface. Small caps look worse than the popular averages. Credit gets more selective. Bid and ask spreads quietly widen. Weak borrowers discover that refinancing is not a theory. It is a test. And tests expose weak balance sheets faster than speeches do. The third phase is the break. That is when isolated incidents stop looking isolated. A regional bank wobbles. A lender pulls back. A deal cannot clear. A fund gates withdrawals. A bond deal fails to attract enough buyers. Commentators insist it is contained. Then another crack appears. Then another. Then the market suddenly remembers that liquidity is not the same thing as price. Price on a screen is an opinion. Liquidity is the ability to get out when everyone else also wants out. Those are very different things. When confidence is abundant, people forget that difference. When confidence leaves, they rediscover it all at once. That is how seemingly orderly environments turn disorderly with terrifying speed. The part that bothers me most is not that some professionals will get hurt. That has happened before and will happen again. What bothers me is how many ordinary families still hold portfolios built for the last decade instead of the next one. They own long-duration promises as though rates and inflation cannot hurt them. They own speculative growth as though capital will always be cheap. They own indexes blindly as though every component deserves the same confidence. They own familiarity. Familiarity is not safety. A lot of bad portfolios feel safe right before they fail because they are full of names everybody recognizes. Now, I know the objection. What if you are too early? That is a fair question, and it deserves a direct answer. Being early can be frustrating. It can make you look cautious while others look clever. It can cost you some upside, but for an investor near retirement, or any investor who cares about permanent capital preservation, being early is not the same thing as being wrong. The cost of caution is often annoyance. The cost of complacency in a real break can be devastation. Missing part of a late rally is survivable. Losing 40% when you need the money is not. That is why I would rather sacrifice a little excitement than gamble with purchasing power. Risk management is rarely glamorous in the moment. It only becomes glamorous in hindsight. I am not interested in winning a popularity contest with the market. I am interested in keeping my family free. That is how I would think if I were managing a household balance sheet right now. And that leads naturally to the next question. How would I structure defense if I thought the next 9 months carried more danger than the crowd appreciated? I would not do it with 100 clever moves. I would do it with a handful of deliberate buckets. The first bucket would be cash and short-term government paper. Not because cash is exciting, because cash is optionality. Cash lets you think. Cash lets you wait. Cash lets you buy when other people are forced to sell. A lot of investors talk about cash as though it were laziness. That is nonsense. In a liquidity event, cash is discipline stored in liquid form. It is not there to impress anybody. It is there to preserve your ability to act when bargains stop being theoretical. If I were building a defensive structure right now, I could tolerate roughly 35% in that bucket. That sounds high to people who only know bull markets. It sounds sensible to people who have lived through true dislocations. The second bucket would be tactical hedges against the weakest parts of the market. I have spent my life preferring ownership over betting against things. That remains my basic temperament. But I am not religious about temperament. There are seasons when fragility is concentrated in obvious places. Highly leveraged companies with poor cash flow. Businesses that only make sense when money is free. Commercial real estate tied to empty offices and cheap refinancing. Regional lenders sitting on assets that look respectable only as long as no one forces a hard mark. The most crowded, speculative growth names that have been treated as if valuation no longer matters. When a market becomes expensive and liquidity becomes scarcer, the weak do not merely underperform. They can break. So I would reserve a meaningful hedge bucket for those parts of the system. Call it 25%. Not because I want to play hero, because if conditions deteriorate, fragile assets tend to fall faster than strong assets rise. The third bucket would be precious metals and related exposure. People always raise an eyebrow when a value investor says that. I understand why. I still prefer productive assets over inert objects in normal times. But investing is not about proving ideological purity. It is about adapting to the environment in front of you, when trust in money itself comes under pressure, and when policymakers may eventually choose currency weakness over honest pain. A measured allocation to gold and silver serves a purpose. No spreadsheet can fully capture. It stands outside the promise. Making machinery, it does not rely on management guidance. It does not need a refinancing window. It simply exists. That matters in a period where confidence in paper claims can get shaken. I would not make it the center of the portfolio. I would make it meaningful enough to matter. Something like 20% in a defensive setup, whether through physical exposure, carefully chosen minors, or a combination suited to the investor's skill and tolerance. The fourth bucket would be energy. That may sound old-fashioned. Good. Sometimes old-fashioned is exactly what a debt-heavy world needs. You can print currency. You cannot print a barrel of oil. You can manipulate sentiment. You cannot legislate real scarcity out of existence. If inflation reaccelerates, or if geopolitical strain compounds, monetary strain, energy producers can become one of the few corners of the market where the asset base still speaks louder than the narrative. I would not overdo it. 10% is plenty, enough to help if inflation bites again. Not so much that your fate rests on a single commodity cycle. The fifth bucket would be defensive businesses with pricing power. That is the part of this framework that feels most natural to me. When the world gets messy, I want to own companies people keep paying even when budgets tighten toothpaste. Soap. Basic healthcare, everyday necessities. Things families buy in bad moods and good ones. A business with pricing power can pass through higher costs without losing the customer relationship. A weak business gets squeezed. A strong business adjusts and keeps producing cash. That difference is enormous when inflation or recession pressure starts attacking margins. 10% in that bucket would make sense in a defensive crisis posture. Add those pieces together and the picture becomes clear. 35% liquid reserves, 25% hedges against fragility, 20% precious metals, 10% energy, 10% defensive businesses. That is not a portfolio designed to win bragging rights in a speculative melt. Up, it is a portfolio designed to survive a break and arrive on the other side with purchasing power intact. That distinction matters more than ever. Now, no structure is complete without a monitoring system. People love opinions. I prefer signals. When fear really starts moving from the margins toward the center, it usually leaves tracks. I would watch 3 of them with unusual attention. The first signal would be the 10-year Treasury yield moving above 5% and refusing to come back down quickly. That level matters because it tells you the bond market is beginning to demand a much harsher price for financing government debt. At that point, interest costs rise even faster. Refinancing becomes more painful, and the market starts questioning whether the old assumptions about easy funding still deserve respect. If I saw that level break and hold, I would reduce risk further and increase liquidity and hard asset exposure. The second signal would be real damage in regional banks, not nervous headlines. Actual price damage and visible stress. Why do I care? Because regional banks sit close to the pressure points of commercial real estate, local lending, and deposit confidence. When that group starts breaking meaningfully, it often tells you that hidden losses are becoming visible losses. A regional banking problem is rarely just about banks. It is about funding confidence in the real economy. If that group fell hard enough to signal systemic stress, I would go to a more severe defensive posture very quickly. The third signal would be credit spreads blowing out. That is one of the oldest tells in finance, before equity investors fully accept bad news. Credit investors often smell it first. When the spread between risky debt and safe debt widens sharply, it means the market is demanding much more compensation to finance weaker borrowers. Translation. Confidence is leaving. Refinancing becomes difficult. Default risk stops being theoretical. When that happens, the stock market usually has not finished reacting. It is just getting started. Those 3 signals together would tell me whether the leak is turning into a rupture. 1 signal means caution. 2 signals mean action. 3 signals mean the storm is no longer on the horizon. It is overhead. And that brings me to the calendar. If I had to map the rest of the year in simple terms, I would think about it in phases. The first phase is the waiting phase. That is where discipline matters most because nothing dramatic may appear obvious on the surface. You keep the defensive structure. You resist the urge to chase strength in the most overowned parts of the market. You collect yield on short paper. You review your hedges. You stay calm, while others call you too cautious. The second phase begins when 2 of the warning signals start flashing. That is when I would harden the posture. I would keep strong liquidity. I would increase the hedge bucket. I would trim anything speculative that somehow remained. This is where many people fail because they want emotional confirmation before acting. Emotional confirmation arrives late and charges a high fee. The third phase comes when the break becomes obvious. At that point, panic replaces debate. Liquidity becomes priceless. Assets that were called untouchable get sold at stupid prices because someone somewhere needs cash now. That is when the preparation begins paying you, not because losses feel pleasant, because you still have the capacity to buy. That is what most people miss. Defense is not merely about losing less. It is about preserving the ability to be aggressive later. A good crisis portfolio is not a bunker. It is a bridge. Then comes the fourth phase, the reversal. This is the part people handle badly because fear is strongest precisely when future returns are improving. You do not switch back to offense because commentators say things are cheap. You switch because the policy response has become real. The forced selling has exhausted itself, and quality assets are available at prices that no longer assume perfection. That is when cash begins moving into durable businesses again. That is when the next decade gets seeded. But you only get that privilege if you survive the break first. That is why I keep returning to the same idea. The order matters. Survive, preserve flexibility, then buy. A great many investors reverse that order and pay for it. They chase first, they rationalize second, they panic third, they miss the real opportunity because they spent their capital and their emotional strength in the wrong part of the cycle. Another lesson matters here. Never marry a position. I do not care how intelligent the original thesis sounded. When the evidence changes, the allocation must change. Pride is expensive in markets. Ego is ruinously expensive. The investor who says, I cannot change now because I will look inconsistent, is already halfway to a bad decision. Consistency in thought is not the goal. Consistency in rationality is. If the central bank suddenly returned to aggressive money creation, if liquidity surged back in force, if the arithmetic softened in ways I do not currently expect, I would adapt. I would not sulk. I would not try to defend an outdated posture. I would change. That is not weakness. That is stewardship. Right now, however, the arithmetic points the other way. The old rescue playbook looks less reliable, because every rescue now carries a more visible inflation cost. That is a trap. If policymakers keep conditions tight, they stress the economy. If they rush to relieve stress, they risk damaging the currency and reawakening inflation. Neither path is gentle. That is why I believe the next serious break, if it comes, will not feel like an ordinary scare. It will feel like the market discovering that the adults in the room do not have an easy button. That is when credibility matters. And credibility, once spent too often, becomes hard to replenish. I know many people will hear an argument like this and still do nothing. That is human nature. In good times, caution feels unnecessary. In late cycle times, caution feels embarrassing. People say, maybe I will wait until the picture is clearer. But clarity usually arrives after the repricing. That is the problem. The market does not hand out discounts after everyone has calmly agreed on the danger. It hands them out during disorder. Preparation has value precisely because it is done before consensus catches up. So if I were speaking plainly to a family that has spent 30 years saving, I would say this. Open the accounts, look at every position without sentimentality. Ask one brutal question. If the next 9 months bring tighter liquidity, higher funding stress, weaker refinancing conditions, and a possible policy credibility problem, does this holding protect my purchasing power, merely accompany the crowd, or expose me to unnecessary harm? Anything in that third category deserves scrutiny. Anything in the second category deserves skepticism. The first category deserves room. Then make the plan concrete, not vague. Concrete, what gets sold first, what gets trimmed over time, how much cash will be held, how much hard. Asset protection belongs in the structure. What risk indicators will trigger stronger defense? What would tell you to move back toward offense later? Put it on paper. Because if you do not make the decision in peace, you will be forced to make it in stress. And stressed investors do foolish things. They sell quality when they should hold. They hold junk when they should sell. They confuse hope with analysis. They turn temporary losses into permanent ones. A written plan does not make you infallible. It makes you less emotional. That alone is valuable. You do not need to predict the exact week a break begins. You only need to recognize that the environment has become less forgiving and position accordingly. That is the real edge. Not clairvoyant structure. I have made plenty of money by buying wonderful businesses and sitting patiently. I still believe that is the best long-term formula in ordinary times. But we are not discussing ordinary times. We are discussing a narrow window where preservation may matter more than participation, where liquidity may matter more than optimism, where arithmetic may matter more than the comforting stories told on television. If the strain passes more gently than I expect, a defensive investor may look a little too careful for a while. I can live with that. If the strain turns into the kind of break I think is possible, the investor who prepared will not merely feel better. He will live better. She will sleep better. They will retain the freedom to choose. And freedom is what money is supposed to buy in the first place. That is why I'm not interested in showing off courage here. Courage is overrated when it is attached to a fragile portfolio. I am interested in endurance. I am interested in optionality. I am interested in being ready to buy extraordinary assets later because I respected the danger early. That is how I would think about the next 9 months. Not as a drama, as a stewardship test. You have spent too long earning your capital to hand it over to a cycle you refuse to recognize. Do the arithmetic, respect the signals. Prepare while choices are still calm. Because once the crowd sees the fire, the exits get expensive.